Welcome to this video presentation on the 2023 forecast titled Navigating the Hurricane. Let's take a look at 2022 in review. Now, it was pretty obvious that in 2022 we saw a major cross-asset bear market. When we look at the 2020 returns across different asset classes, a lot of interesting things emerge. But what was remarkable was the correlation amongst asset classes. It was almost like there was one switch which dictated the direction of each asset class for various periods of time during the year. Effectively, it was all one trade. And that's because inflation and ultimately Fed policy and interest rates drove the show, which in turn drives liquidity, which also drives most markets. Now, there are actually two ways to measure liquidity. The first is net liquidity, which measures how much the Fed created and is circulating. The second way is to look at world dollar liquidity, which measures M0 plus foreign securities held at the Fed. Now, when we look at both of these metrics, they both do pretty well in predicting asset prices, especially those that are sensitive to liquidity. For example, we see in both charts local bottoms in early July and early October, which correspond to local bottoms in the S&P 500. My point is that it's very easy to say something like there's so much liquidity in the system. It's another thing to quantify it in order to track inflection points, and the reality is liquidity has been draining from the system since the beginning of 2022. Which brings us to present day. What can we expect moving forward? Powell has stated that he will bring rates higher for longer in order to tame inflation. I've said it before. I think we should believe him. But markets move on rate of change. And so while Powell will hold the rates higher for longer, it's really a question of the rate that happens, as well as compared to what, especially since inflation is finally materially dissipating. So what's likely to happen with the Fed is that once the Fed funds rate increases above the rate of core inflation, either by hiking rates higher, core CPI and PCE coming down further, or a combination of both, the Fed will pause and keep rates at the point until a new catalyst emerges. Historically speaking, the Fed doesn't pause before this occurs, and generally finishes hiking when it does. Understanding this historical behavioral pattern allowed us to ignore all of the noise coming from financial news media about a pivot coming during the summer of 2022. So why am I bullish in the near term? Well, one of the inputs to the net liquidity function is the value of the Treasury General Account. The Treasury General Account is essentially the U.S. Treasury's checking account at the Fed. It has an inverse impact on the liquidity in the system. When the account gets drawn down or goes lower, that means that the Treasury is spending their money, and as the money gets spent, it gets injected into the real economy. So despite the Fed pausing, there'll still be quantitative tightening. The liquidity is still being drained from the system. However, and the Fed has not, as of this moment, indicated that they will be increasing the pace of quantitative tightening. On the other hand, the government's debt ceiling battle likely means that the U.S. Treasury will be draining the Treasury General Account, a net increase in liquidity. The reason for this is the Treasury can't come back to Congress and ask for money if the accounts are flush with cash. And so what you typically find during these debt ceiling debates is that the TGA draws down to $150 billion or so. And so if we kind of project out, this movement over the next quarter or so, which means liquidity is being introduced into the system, which is ultimately good for risk assets. Now, I think these two catalysts will ultimately mark the end of the bond bear market, which should mark near the bottom of asset price valuations. And this may come as early as July, we may be experiencing this right now, or it may come as late as May. Additionally, China's reopening has historically been a boon to global GDP, and this week's announcement is a welcome surprise. Though I don't believe China's stimulus will be as potent as in the past, I do expect the reopening to boost the U.S. economy, markets, as well as inflation. Speaking of inflation, European core inflation continues to rip higher, while U.S. core inflation seems to be coming down. European inflation tends to lag U.S. inflation by about 6 months, so European monetary policy stance is going to be similar to the Fed during the summer. And if you recall, that is when, Jerome Powell and the Fed hiked 75 basis points 4 times in a row. This matters because for a window of time, the European Central Bank will need to be more aggressive than the Fed, right? Remember, not only is it rate of change, it's rate of change compared to what? Now, this ultimately signals, or is likely to signal, that the euro will strengthen against the dollar. Along with the Bank of Japan's de facto tightening, this is overall negative for the US dollar index, where the euro and the yen make up about 71% of the entire index. While I still believe that the next 3 to 5 years will see the US dollar continue to strengthen, it's important to separate the short and long-term horizons. As we can see here, the dollar index has already come off of its peak, and not just a dip. Currency trends tend to be pretty sticky and slow. And so I do believe that this recent quote-unquote dip is actually more of a inflection point, a change of direction. So where does that leave us? The bear markets in 2022 were driven nearly entirely by valuations, with stock PE or price to earnings ratios, a way to measure valuations in public equities, dropping from 30 to about 20. But earnings and earnings estimates still remain positive, a testament to a resilient U.S. economy, at least in nominal terms. While longer leading indicators are pointing to a recession, potentially a major one, topic for a different video, the deceleration of the economy has been very light in normal terms. If inflation does continue to abate as expected, the economy may even accelerate when measured in real terms. Using historical averages to predict timing suggests that a recession may not actually hit until the end of 2023. So what do we have? If we have liquidity pressures easing up soon, we have China reopening, we have the dollar weakening relative to other currencies, and the job loss earnings recession is later on in 2023, this creates an air pocket where risk assets can actually do well, particularly those sensitive to liquidity and valuations adjustments. Now, one approach you could play this from an investment perspective is to overweight assets on opposite sides of the risk spectrum. For example, short duration treasuries and Bitcoin are highly sensitive to liquidity and rates, but occupy opposite corners of volatility. Short duration treasuries will pay you to wait for the first time in a long time and is expected to do well if recession hits sooner than expected, right? This is betting on things that you expect to do well, but will also do pretty well if you're wrong. We call that hedging. On the other hand, Bitcoin stands to appreciate the most from Fed policy easing. For reference, when the Fed pivoted in 2019 in the infamous Powell pivot, Bitcoin's price appreciated 4x, a fact that is often forgotten by people who classify the previous bear market as crypto winter. Other risk assets did very well. That's not a 4x. Given that monetary policy is still tightening through quantitative tightening, I don't expect appreciation to the same magnitude, right? Bitcoin 4xing. But I wouldn't be surprised if Bitcoin appreciates 2x if the waters are calm long enough. Now, that is my disclaimer, my caveat, which I'll describe more. The eye of the hurricane, and I use this description intentionally, as the relative calmness can lull people into a sense of complacency, much like how an actual eye of the hurricane can falsely send an all-clear signal. Now, one thing to note is that this view is actually against consensus, right? Wall Street consensus is some version of the first half of 2023 is bad, whereas the second half will be better for risk assets. Now, this is obviously the exact opposite from where I stand from a timing perspective. And I've held these views for some time. Fortunately, the first few weeks of 2023 have been confirming of my thesis. That being said, I believe good macro-aware active managers will outperform passive managers in 2023 and potentially for the next few years. I also believe that 2023 will actually be more challenging than 2022. The macro playbook for 2022 was actually pretty simple. Short, or at least lighten up on risk assets, hold dollar cash, just go on vacation. Nearly all of the forces, Fed policy, fiscal policy, inflation, growth, liquidity, all pointed in the same direction. Bad, get out. I'm quite confident that 2023 will instead feature countervailing forces, like two sumo wrestlers locked in a china shop, and I use the word China very intentionally. What I've laid out in this video is a path that I think is most likely to happen, given historical averages. However, the word average is a dirty word in finance, and for good reason. For example, if the Fed ends up hiking until May, right, towards the end of my estimate window, and the recession ends up coming 2 quarters earlier than expected, then those 2 parts of the hurricane will hit back to back. And in this scenario, risk assets stand to lose a lot. And this is ultimately how we get to see, a sub 3,000 S&P 500 and a 10K Bitcoin. So even though I do believe this is the most probable path, and I'm positioning my portfolio in this way, it pays to be nimble in case you're wrong. At the end of the day, all we can do is play the probabilities with the hand we've been dealt and manage our risk accordingly. Good luck.